Citi to cut 20,000 jobs through 2026. Swings to $1.8 billion loss. Citigroup will cut 20,000 jobs over the next 2 years, the bank said on Friday, after reporting a $1.8 billion quarterly loss driven by a string of one-off charges. Shares of the bank, which has rolled out a multi-year effort to cut bureaucracy, increase profits, and boost a stock that has lagged peers, fell more than 1%. The fourth quarter was very clearly disappointing, CEO Jane Fraser told analysts. We know that 2024 is critical. The lender will reduce its global workforce of 239,000 by 20,000 through 2026, including layoffs from the sweeping reorganization, Chief Financial Officer Mark Mason told reporters. Citi also expects to no longer count 40,000 jobs when it spins off and lists its Mexican consumer unit Banamex in an eventual initial public offering. Given the headcount reduction and separation of Banamex, it aims to reach a staffing level of 180,000 employees, Mason said. Analysts said results from the third largest U.S. lender by assets were strong when the one-off charges were excluded. Citigroup's earnings looked awful with a big loss of $1.8 billion, but the bank's underlying business showed resilience, said Octavio Morenzi, CEO at management consultancy firm Opimas. The loss was driven by $3.8 billion in charges disclosed in a filing on Wednesday that included reorganization expenses, a reserve related to currency devaluations and instability in Argentina and Russia, and a $1.7 billion payment to replenish a government deposit insurance fund. The bank expects to report between $700 million and $1 billion in charges this year related to severance costs and the reorganization. Whenever an industry or company goes through these types of reductions, it's tough on morale, Mason told reporters. The staffing cuts will not affect revenue growth, he said. Rivals J.P. Morgan Chase and Bank of America on Friday reported lower quarterly profits, while Wells Fargo outperformed on cost cuts. Citi's revenue fell 3% to $17.4 billion in the quarter from a year earlier. It was the first time the bank broke out earnings for its 5 businesses: services, markets, banking, U.S. personal banking and wealth, which were previously housed under broader divisions. Revenue from markets, or the trading division, dropped 19% to $3.4 billion from a year earlier. It was dragged lower by a 25% plunge in fixed income revenue from sluggish rates and currency markets, as well as losses from Argentina. In contrast, banking revenue climbed 22% to $949 million, led by higher investment banking fees for debt capital markets and advisory work that offset a slide in corporate lending. In U.S. personal banking, revenue climbed 12% to $4.9 billion, lifted by retail banking and credit cards. But consumers have begun to show signs of stress, prompting Citi to set aside more money to cover losses on souring loans. The restructuring announced 2 months ago was a long time coming, said Chris Marinac, Director of Research at Janney Montgomery Scott. The question comes down to, can they execute on this restructuring in terms of really being able to grow the core business? The jury is still out. As the losses mounted, drastic measures were on the horizon for Citigroup. The writing was on the wall. Changes needed to be made, and they needed to be made fast. But what would these changes entail, and how would they affect the thousands of employees who depended on Citigroup for their livelihood? As the losses mounted, drastic measures were on the horizon for Citigroup. This was just the beginning of the struggle for one of the world's leading banks. The road ahead was fraught with challenges, and the decisions that lay in the future would shape the destiny of Citigroup and its employees. The struggle for Citigroup didn't stop there. The year 2023 was marked by a series of unfortunate events for the financial giant. Despite their best efforts to navigate the choppy waters of the global economy, Citigroup found itself in an even deeper financial rut. The company's strategies to turn things around proved to be ineffective. The ambitious plans to restructure its operations, the attempts to streamline its services, even the bold moves to venture into new markets all fell short of expectations. Instead of the anticipated upturn, the company faced additional losses, adding to the already hefty burden of the $1.8 billion deficit reported the previous year. The impact of these financial setbacks was not confined to the boardroom. The ripple effects were felt by everyone associated with Citigroup. Thousands of employees who had dedicated their careers to the company found their futures hanging in the balance. Shareholders, many of whom had invested their life savings, watched in dismay as their investments dwindled. But the fallout extended beyond the company's walls. The public, who had long regarded Citigroup as a pillar of the financial world, reacted with shock and disbelief. The media was abuzz with speculation and analysis, each new headline painting a bleaker picture than the last. The loss of confidence was palpable, and the once revered institution was now a subject of scrutiny and concern. In the face of these mounting challenges, Citigroup was left with few options. The company had to find a way to stem the tide of losses, to restore confidence, and to secure its place in the financial sector. But the solutions were not easy, and the decisions were not without consequence. With the situation growing increasingly dire, Citigroup was forced to make a tough decision. In 2024, Citigroup made an announcement that sent shockwaves through the financial world. The banking giant unveiled a plan to cut a staggering 20,000 jobs by 2026, a decision that did not come lightly. This drastic measure was a response to the company's financial struggles, with Citigroup reporting a loss of $1.8 billion. The decision was driven by the need to streamline operations, reduce costs, and ultimately, to regain the financial ground lost over the past years. The weight of this decision was felt across the board. Employees who were the direct victims of this move faced the grim prospect of unemployment. It was a bitter pill to swallow, but the company assured that the layoffs would be managed as sensitively and humanely as possible. Shareholders, on the other hand, were torn. While some saw the layoffs as a necessary evil to steer the company back to profitability, others were concerned about the potential damage to Citigroup's reputation and morale. Yet, the overriding sentiment was one of cautious optimism, with many hoping that these cuts would be the bitter medicine needed for a healthier financial future. The market's reaction was equally mixed. While some investors were spooked by the news, fearing a ripple effect throughout the financial sector, others saw it as a sign of Citigroup's commitment to course correction. The announcement, in fact, led to a brief uptick in Citigroup's stock price, indicating that Wall Street was willing to bet on Citi's strategic move. The decision to cut jobs was not an easy one. It was a move born out of necessity, a tough call made in the face of mounting losses and a challenging economic climate. It was a decision that, while painful in the short term, was aimed at long-term survival and growth. While the decision was a harsh one, it was seen by many as a necessary step for Citigroup's survival. And with this step, the banking titan hopes for a future where it can once again stand tall and strong in the world of finance. What does the future hold for Citigroup? It's a question that has been echoing through the halls of Wall Street and beyond. As we look ahead, the landscape is filled with uncertainty. With a loss of $1.8 billion and plans to slash 20,000 jobs by 2026, Citigroup stands at a precipice. Experts are divided on what this could mean for the financial behemoth. Some foresee a phoenix-like rebirth, with the bank emerging leaner and stronger from its self-imposed austerity measures. Others are less optimistic, predicting a continued downward spiral that could potentially shake the very foundations of the financial industry. The road ahead for Citigroup is uncharted, fraught with challenges and opportunities alike. Their decisions in the coming years will not only shape the future of the company, but potentially the entire financial sector. Only time will tell if Citigroup's drastic measures will lead to a financial turnaround, or if this is the beginning of the end for the financial giant.